You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 9th of August 2026. I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Domino's, Diageo, Coca-Cola HBC, Novo Nordisk, Tritax Big Box REIT, and our US company of the week is Eli Lilly. John, should I start us off with Domino's?
Yes, how are they doing?
Pretty well, actually. So, Domino's UK, we have covered them multiple times before. For anyone who is unfamiliar with Domino's, they do pizza, and Domino's UK, they have the license for UK and Ireland, and they also own 30% of Polish Domino's for reasons we're unsure of, but especially after they made a big effort to get out of Central Europe a few years ago and got rid of all their other ones. So they have come out with half-year results for the period ending 28th of June 2026, and system sales were up 6.1%. Group revenue was up 6.7%. Underlying EBITDA was up 3.6%, and underlying profit before tax was up 0.9%. Statutory profit before tax was up 0.2%. Underlying basic earnings per share was up 4.8%. Statutory basic earnings per share was up 5.3%. Underlying free cash flow was up 74.9%, and the dividend was up 2.8%. In the highlights, they've highlighted that there was strong first half trading performance, with like-for-like sales up 4.9% and orders up 1.6%, driven by growth in both pizza and chicken dip, as well as an uplift from the World Cup. So the chicken dip's quite interesting because I hadn't come across that. So it's basically like a chicken range that they're doing, but I think not as a side, but like a full kind of main chicken range, with I think the idea of sort of taking on like KFC and whoever else and having to go at the chicken market. They've got higher underlying free cash flow of 50.2 million, reflecting higher earnings and improved working capital. They made market share gains across pizza and chicken. They've maintained their industry-leading delivery times at under 25 minutes, and they've highlighted the successful launch of chicken dip as well as the Italiano's pizza range, and they opened their 1400th store with 11 opened in the period. In terms of the current trading outlook, they had positive trading in July, supported by the World Cup. They're confident in achieving full-year expectations. All major cost lines are hedged for 26 and into 27, and strategic plans provide confidence in driving earnings growth in 2027 and beyond. In terms of the valuation, business trades at a P of 11.68 and has a yield of 5.5%. I think these results are very good. I think they'd had a bit of a wobble recently. They seem to be bouncing back a bit now, but these are the best set of results I think we've seen from them in a couple of years. I have held them in the past, albeit very briefly, and I did sell them not too long after buy-in. The main reason was at the time they were looking for a second brand, and that was part of the thesis that it's quite fairly valued, but if they can get a second brand and they can sort of leverage that expertise, who knows what could happen. But then basically the first set of results after I'd bought it, they said they're no longer looking at a second brand. However, the launch of chicken dip is quite interesting, so I think that is something to keep an eye on, because I could see that doing pretty well. But yeah, I think these were a pretty positive set of results for them. And I think when you compare the valuation, let's have a look at Greg's, which we did cover last week. Yeah, so Greg's is trading at a P of 16, and we did cover it last time, and I know they are still growing a bit more, but I don't think that difference in growth is really enough to justify the valuation. I think they've got the same saturation issue that Domino's has. I do just think Domino's is much more fairly valued when that is taken into account. So yeah, I think it's pretty attractive. I think someone could make an argument for it. I don't think I'd be interested in diving back in, because I think that second brand was key, but the chicken dip I think is encouraging. What about you, John?
Yeah, no, I would agree with you. I think the chicken dip, it's not a second brand in itself, but it's within all of the Domino's stores. And I think the question that I always had with Domino's in the last couple of years is, where does the future growth come from? Because they're pretty saturated, and they literally just offered, well, I know they had a few sides, but like it was basically just pure play pizza. Whereas now, and I suppose there's only so much pizza, one can eat. And now that they've got that chicken dip, they're almost combining both into their overall brand. It looks like they've got similar dips to Domino's. So that was quite a lot of people would say, oh, it's a bit of a USP with some of the Domino's dips. And yeah, I think for the current valuation and potentially with the growth that they could get from the chicken dip, I think it's more attractive than it's been for a long time.
Should we move on to another company that's at quite a cheap valuation at the minute?
Yeah, no, absolutely. So it's one that we've covered lots of times. It's Diageo, which is, for anyone who doesn't know, the owner of Johnny Walker, Guinness, Smirnoff, Captain Morgan, Tanqueray, Gordon's, Bailey's, a huge number of spirits. And obviously it's got that very famous stout brand, Guinness. And they had their full year results out with full year net sales coming in at $19.6 billion, which was as expected, down 2% organically, with volumes and prices both falling. This was driven by declines in North America and Asia Pacific, which more than offset growth in other regions. Underlying operating profit increased by 2% to $5.7 billion against $5.6 billion expected, excluding around $900 million of restructuring charges taken over the year. Free cash flow increased by around $500 million to $3.2 billion, and net debt decreased by 1.4 to $20.5 billion. The final dividend has been cut by 30 cents a share, which is down 52%. 2027 guidance points to flat organic net sales growth, with underlying operating profit to grow in the low to mid single digits. And the shares were up 6.5% on the news. I thought these results were actually okay. I think the main thing that I sort of take from this is that Dave Lewis is making some big calls. He is, I think, cutting the fat, and that's almost what he's known for doing, sort of being drastic Dave. I think also the strategy in terms of having more ready mix cocktails. We've seen it with the Funkin brand here in the UK. That is a growth market. And it's strange that Diageo have kind of sat on the sides with that. I think that will increase volumes. I think other things that they're doing is pushing some of their lower and mid-tier spirits. I think they're making those a bit more attractive, certainly in terms of price, to increase the volumes. And I think at the same time, they're doing that. They're not devaluing some of their really top brands. So I think that sort of strategy overall is a good one. It looks like they're trying to repair and improve relationships with off-trade, which historically, I wasn't aware of this, had been pretty poor. So doing that, you would hope after, or over the next year, would produce some sort of tangible results. Just having a look at any other notes from the Capital Markets Day. So yeah, targeting $1 billion of planned savings over 3 years, redesigning operating framework. So you think they've basically got a plan to add to the top line and also to the bottom line, with some of these savings. Dave Lewis, he hasn't quite been there for a year, but he's been there now, getting on for that. So I would still give him some more time. And I think at the current valuation, it's reasonable. And I think there are some early signs here. So I'd be hoping in a year's time, when we're covering it again, that we are really seeing those things come through. Sam, what are your thoughts?
Pretty similar. I'm pretty happy with it. So I think we're both shareholders of this one. I'm pretty happy. I'm happy with the debt coming down a bit. It's nice that he's addressing that. I like the dividend being cut. The cost savings, they seem pretty achievable. He seems to have steadied the ship on the volume declines, although it's still declining slightly. Although a lot of regions aren't, albeit with North America being the most important region, still in decline. But I think I just find it's almost quite surprising reading through it, actually. I think because it had done so well for so long, I don't think I'd fully appreciate just how much fat there was to trim. Because he's actually had quite a lot he can go at. And I think, if you can take that debt out or get it down significantly, that would make a big difference just on its own, even if everything else stays the same. Then you've got the cost savings. I think he probably can get revenue growing again. So yeah, I think it's pretty encouraging. And I think it's fair to say we've both got a terrible track record of buying turnarounds.
Yeah.
In terms of the first set of results since the new manager's come in, this is probably the best one I can remember for a long time. If you compare it to, say, Unilever, for example, where even before Fernandez decided to sell everything. Even that first set of results weren't amazing. The guy before him, his first full set of results weren't amazing, and there'll be lots of others. Whereas with this, I think there's clear signs that it's already moving in the right direction. So yeah, I'm very happy with this.
Yeah, I mean, I think one thing that I would caution with is I think there's an awful lot to turn around here at Diageo. I suppose in terms of investment thesis, comparing it with, let's say, 5 years ago or 6 years ago, before you had any sort of hint of GLP-1s radically changing the market, you do wonder longer term what the GLP-1s will do for this market. And I think certainly there's a lot to turn around, even in a world where GLP-1s are widespread. But I would wonder, once this sort of initial turnaround has taken place, I would probably reevaluate things, I think, with Diageo overall.
I think that will be partly reflected in the multiple as well.
Yeah.
Like, I don't think it's ever going to get, or certainly in the medium term, unless something radically changes. It seems to fluctuate between 25 and 35 PE, depending on how choppy the market was.
Yeah.
I can't see it ever getting back to 35.
Yeah.
So I think if you're holding it, thinking that nothing's going to change and the multiple is going to go back to where it was, that's probably not going to happen.
Yeah.
I could see it kind of, I mean, at the minute it's at forward of 14. I could see it getting back to 20. And then if you think the earnings will probably have been improved as well, you could still do very well on it. But yeah, those multiples we'd gotten used to, I think, are probably gone.
Yeah, no, that's right. So, well, certainly for me, I'll see how things go over the next year and what the signs are looking like then. But I am cautiously optimistic.
Now that we've got some spirits out of the way, should we move on to our mixer?
Yeah. So I don't think they've combined yet. I think actually the Captain Morgan's and Coke is not Coke, it's Pepsi. But anyway, how are Coca-Cola HBC doing?
So Coca-Cola HBC are doing very well, as always. We have covered them multiple times before, but they are Coca-Cola Hellenic bottling company. So they're basically the Greek Coca-Cola. But what they have is they've got the licenses for most of Eastern Europe and quite a few other emerging markets. But they've got like Egypt and a few other developing markets spread around the world. They've also got most of Central Europe as well. And then as well, we covered it last time, but they've got a deal currently going through, which hasn't completed yet, to basically buy the African, or a load of African licenses, so like 12 or 13 of them. So they have come out with their 6-month results for the period ended 3rd July 2026, and volumes were up 7.5% on an organic basis. Net sales revenue was up 9.6%. Net sales revenue per unit case was up 1.9%. Operating profit was up 15.9%. Comparable operating profit was up 15.2%. The EBIT margin was up 50 basis points to 12%, and the comparable EBIT margin was up 60 basis points to 12.2%. Net profit was up 11.4%. Comparable net profit was up 15.5%. Basic earnings per share was up 11.1%. Comparable earnings per share was up 15.2%, and the free cash flow was down 11.8%. And in the highlights, they've highlighted that organic volume grew 7.5%, which we mentioned, but that was driven by sparkling up 6.4% and energy up 26.1%. While Q1 benefited from 4 additional selling days, Q2 volumes accelerated on an underlying basis to 5.8%, underpinned by broad-based strength across all segments. Underlying revenue per case growth of 1.9% reflected targeted revenue growth management initiatives despite the country mix. Value share growth of 80 basis points in non-alcoholic ready-to-drink and 40 basis points in sparkling year-to-date. Comparable gross profit margin grew 110 basis points to 37.8%, benefiting from good top-line leverage. OPEX as a percentage of revenue increased by 50 basis points year on year, reflecting increased marketing investments in key events and innovations. And in terms of the revenue growth by segment, they split their countries into established, developing, and emerging. Established, that organic revenue was up 6.2%, and that was led by volume growth, and organic EBIT increased 6.9%. Developing, organic revenue was up 9%, driven by both volume growth and revenue per case expansion, with organic EBIT up 1.8%. And emerging, organic revenue was up 12%, driven by strong volume growth, with organic EBIT up 23.9%. Coffee grew 24.5% in out-of-home channel, which is their strategic priority. So it's nice that someone can do something with Costa. And they remain on track to complete the acquisition of Coca-Cola Beverages Africa during the second half of 26. They've been cleared by antitrust authorities in 4 out of the 6 jurisdictions to date. And in July, the South African Competition Commission recommended that the Competition Tribunal approve the transaction with conditions. And just to summarise, in terms of the markets that they are in currently, so this ignores the additional African ones that they're going to be getting. They are in Armenia, Austria, Belarus, Bosnia and Herzegovina, Bulgaria, Croatia, Cyprus, Czech Republic, Egypt, Estonia, Greece, Hungary, Ireland, Italy, Latvia, Lithuania, Moldova, Montenegro, Nigeria, North Macedonia, Northern Ireland, Poland, Romania, Russia, Serbia, Slovakia, Slovenia, Switzerland, and Ukraine. So I think basically once you get past Germany, you struggle to find a country they're not in. And in terms of the business outlook, they have said organic revenue growth is now expected to be at the top end of the 6 to 7% range. And organic EBIT growth is now expected to be in the range of 8 to 10%. And that's up from 7 to 10% previously guided. In terms of the valuation, the business trades at a P of 21.22 and has a yield of 2.09%. I think these are a fantastic set of results. Would I want to pay 21 times earnings? I don't. I think I'm a bit anchored to where it used to be. So for context, in the last 5 years, the shares are up 86%, and that's at the compared to the pre-Ukraine price. So when Russia invaded Ukraine, basically 2 of their markets were wiped out overnight. So it was at about £26 a share. Russia invaded Ukraine, and kind of within a few days, it's down at £16 a share. Since then, it's risen. It's now just under £50 a share. If we had bought when Russia invaded Ukraine, it would have been more than a 3x, which is pretty painful because I think we both recognised what a high quality business it was, but it is what it is. But yeah, fantastic business. I don't think it's outrageously valued given the numbers that they keep putting up, but I think for me, I would probably want to try and get it at a lower price, but that might just be anchoring. I think one thing that is I forgot to mention as well was premium spirits. So they have the licenses for all the Coca-Cola brands, which we talked about. But then as well as that, they have their own brand that's a spirit brand called Finlandia. So volumes declined by 1.5% for that. And they've said that's due to tough comparatives, and they were impacted by retail challenges in Poland, which have now been resolved. Excluding this impact, the overall category would have been in growth, and Finlandia would have grown low double digits. So that's also pretty positive. So yeah, I think it's a really great business. I would just like to see the price come down a bit. What about you, John?
Yeah, I mean, it's anchoring bias for sure, but brilliant business. It continues to kick on. And sort of kicking myself that when we saw the signs, it's a bit, it's still a bit pricey. I mean, initially it was the uncertainty about what would happen after the war in Ukraine, and then we saw that the numbers were still good despite that. And I think then we really should have just pulled. I mean, it's easy in hindsight, or with hindsight, pulled the trigger then. But instead, we've just watched it perform and perform. And it's that anchoring bias. But yeah, you don't get high quality businesses, or they don't come around at a cheap valuation regularly. So yeah, sad.
I think in one sense we were slightly unlucky in that we hadn't been covering that long when Russia invaded Ukraine. So I think we'd only maybe covered it once before that. So we weren't that familiar with the business. I think if we'd started covering it a year earlier, that could have made a difference. But then yeah, it's just frustrating because I think it was pretty obvious that it was a very high quality business. And yes, there was that uncertainty, but I think really the period that you can't help but kick yourself or is even after Russia invaded Ukraine, that's 6-12 months.
Yeah.
And we'd got anchored to that price immediately after.
Yeah.
And it had rebounded by like 30% to where it was. It had shrugged it off. And we're like, I'm not sure. 2 of the markets are still gone.
Yeah.
And then obviously since then it's more than doubled.
Yeah.
So yeah, I think that's the annoying thing because it was pretty. It's been like 5 years or whatever it is, 4 or 5 years since Russia invaded Ukraine.
Yeah.
We had a good. It's only in the last sort of year, 2 years that it's really run up. So we had plenty of time, and it wasn't that, it was at like 17 at that point and putting up great. Anyway, that's life.
Yeah, that's right. Absolutely. So
On to one that we did buy and I've sold. I
was going to say on to the second our second turnaround of the week, Novo Nordisk, which is pharmaceutical company, well, most famous for its diabetes, and probably Ozempic and Wegovy, the weight loss stroke diabetes medications. Anyway, they had their Q2 results out last week, with underlying sales increasing by 7% before currency moves to 78.5 billion kroner. So it's Danish kroner, all these results. And that was driven by volume growth in GLP-1 sales in both the US and international divisions, which more than offset a decrease in prices. Operating profit was up 11% to 33.4 billion kroner, while free cash flow increased by 57% to 42.5 billion kroner. And that was driven by operational performance and a decrease in capital expenditure. Net debt fell by 8.9 billion kroner in the first half to 86.5 billion kroner. And that was after 41.2 billion was returned to shareholders in share buybacks and dividends. Both adjusted sales and operating profit growth guidance has been raised between -6% and 0%, and the shares were down around 4% in early trading. In terms of valuation, the group have a market cap of £114 billion and trade at 14.4 times forward earnings, compared with a 10-year average of 22.8, and they have a prospective yield of 3.8%. I actually thought these results overall were fairly encouraging. I think it's an incredibly competitive market in the GLP-1 space, which is much of where the focus has been for the last few years with Novo, rather than its traditional diabetes business that was more of a sort of gradual plodder. It's a huge market for GLP-1s, and their products are significantly cheaper than that of Eli Lilly, which we'll come on to later, with similar results, certainly if you take 3 times the dose of Wegovy, which is now licensed. And then there's the Wegovy pill as well, which is doing well. And then there's also the next generation product, CagriSema is one of them, and they're looking at higher doses of that to get similar efficacy when it comes to weight loss compared with the rivals like Eli Lilly. I think there are a number of issues, and one of them, and one of the major ones in the last couple of years, is how poorly managed the business has been. There have been so many own goals, considering they were the market leader, and they've completely blown that. They're now number 2, and a much, much smaller number 2 compared with Eli Lilly. But I think there are some encouraging signs in terms of sort of turnaround. And I think one of the things, and certainly in my view, that's often overlooked is the traditional diabetes business, which is still very much there. And I think this business, it's profitable whether you have the GLP-1s or not. So I think if they can still make progress, particularly with the oral Wegovy, with the CagriSema, then it doesn't look very expensive at 14.4 times forward earnings. I suppose, we don't know what the management going forward is going to be like, and whether it's going to be a total step change from what went before it. And I guess that undermines a lot of confidence that you might otherwise have in the business. But I think it's still appealing at the current valuation, and I'm still holding it a few years. Well, I'm not sure how long ago was it. It's been I'd say probably getting on for 18 months since I first bought my initial shares in Novo. But I'm actually quite happy holding it, although I do appreciate some other bigger shareholders like Terry Smith have now sold their shares. Sam, what are your thoughts?
I'm a bit disappointed that you didn't refer to me alongside Terry when you said that some of the bigger shareholders have sold. But, perhaps we're not in the same bracket yet. I agree, these are probably the best set of results we've seen for probably 2 or 3 years from Novo Nordisk. However, I think it is also a sign of just how low expectations have dropped, because sort of when you think they had this market wrapped up entirely to themselves, and they're now a distant number 2. Sales growth of 7%. It's decent for a massive pharmaceutical business, but compared to what it could have been had they not been so poorly managed, it doesn't really compare to the figures they could have been putting up. I'm surprised, that being said, that the shares were down on these results, because they're better than expectations. They've raised guidance. I don't know what more people were expecting, but it might just be that it'd run up a bit recently and people had maybe been hoping that it would have been an even higher beat. But I think based on everything they've seen for the past 2 or 3 years, that was maybe not a realistic expectation. Part of the reason I sold was because it was part of the portfolio that was moving over to Joe to manage. And since I'd bought it, it had done terribly, but not just in terms of the share price, but operationally. I'd been really disappointed with the number of own goals that they seem to have had. So for me, it was quite an easy one to get rid of because I'd done terribly on it, and I'd rather keep a business that is actually doing well and I like. Would I consider buying back in? I think it would take a lot more, because I think that the main argument at this point is just the price. And I think whenever I've done that in the past, it's not gone well for me. So I think I'm quite happy watching from the sidelines now. But I think I did basically sell around the lowest point. So
Okay, fine. Now, I would say I must be down about 25 to 30%, something like that.
Yeah, I think I was more like 35, 40 when I sold.
We'll see. I'm happy holding it for now. All right. So moving on then, Sam. How are Tritax doing?
I think they're doing pretty well. So Tritax Big Box REIT, we have covered them for a while. They are a real estate investment trust, hence the name. And they mainly sort of do the massive warehouses that you see for like companies like Amazon. So they will have them, they will build them near motorways, stuff like that. And then large companies can use them for like distribution or whatever else. And that's basically their business model. So Tritax have come out with half-year results, and first half net rental income grew by 16.2% to 173 million, and that was driven by underlying rental growth in the logistics portfolio of 5.1%. And it does also include the acquisition last year from Blackstone. So again, we did cover it last year, but I think Tritax and Blackstone were both trying to acquire warehouse REIT, which would have complemented a lot of Tritax's properties very well. I think they lost out. They weren't willing to pay what Blackstone was willing to pay. However, on the back of that, Blackstone, to actually fund the acquisition of Warehouse REIT, needed to get rid of some of their logistics properties. So quite a big chunk actually moved over from Blackstone to Tritax to facilitate the acquisition of Warehouse REIT by Blackstone. Operating profit was up 6.1% to 153 million, lagging rental income largely because of the absence of income from development management. Portfolio value fell 2.7% because of disposals and lower property values. And Tritax have also completed an equity fundraise. That was at a price of 164p. That was a 4.5% discount to the close at that point the previous day. However, it's now at 166.3p. So it was only slightly below the current share price now. And the transaction is intended to accelerate development in the company's data center pipeline. The shares fell 4.2% following these results. So in terms of the data center, what they're planning to do is use their land and their development expertise to unlock grid-connected sites for occupiers. To get into data center, it is quite difficult because they are very expensive to build. And because they're a REIT, they can't retain, I think they have to pay out 80-90% of their earnings as dividends to maintain their REIT status, which means they're not paying corporation tax. So it makes actually funding the expansion quite difficult. So that's why they've been selling some of the lower yielding mature assets. Oh, and as well, in 2024, they merged with UK Commercial Property REIT. So again, they've been selling some of the unwanted assets from that merger. So yeah, mainly selling lower yielding assets, and they're using that to fund the data center expansion so that they've got the cash to do it without losing the REIT status. Because as I said, the earnings have to be paid out basically. In terms of the valuation, they trade at a forward price to book of 0.82. That compares to a 10-year average of 0.9. And the prospective yield in the next 12 months is 5.1%. That compared to a 10-year average of 4.7%. I think these are a pretty good set of results. I think the data center is quite interesting. I think they were already quite an attractive REIT because of those big distribution centers. And they are just the kind of properties that it's not like high street exposure or anything where you'd maybe be a bit more worried about it longer term. I think there is a clear long-term tailwind. I think with data centers, that's even more the case. I think the valuation is actually more reasonable than it's been for a while. And given that I think that growth looks more exciting than it's been in a while as well. Yeah, I think it looks pretty attractive. And I'm probably, it's the same thing I say every time. I think the only reason I haven't bought it at this point is opportunity cost. I would need to sell something else. I'm perfectly happy with Supermarket Income REIT, which is the only REIT that I do own at present. But if I was to add a second, I think it probably would be Tritax. Should mention as well, it's currently trading at a 10% discount to net asset value. However, I wouldn't get too excited about that because REITs typically do trade at around kind of 10 to 20% discount to net asset value. John, what are your thoughts on these results and also the expansion into data centers?
Yeah, no, I think certainly these results pretty decent. And I think in terms of data centers, I think I like it overall. I don't see the data centers in the current environment in the UK growing rapidly, and that's just on the basis of the energy costs in the UK being so high. I suppose you could argue that they do need to be relatively close to places in terms of finance, because that can convey an advantage across in terms of lag and things.
We're not going to dominate the global market for data centers, but I think there will be certain ones where even though the energy might be outrageous, it still needs to be in the UK, and it makes financial sense for it to be so. And I think that's what they're going after.
I think you'd probably see, if we had energy prices coming down significantly in the UK, particularly if you had, for example, a lot of North Sea drilling, whether that would lead to growth in data centers in the UK. So there could be an argument there. But overall, I think it's a well-run company. There are a lot of attractive REITs in the UK. The ones that I hold are Supermarket Income REIT, and it's come up in valuation in the last couple of years. But that's one that I certainly think is still attractive. I think Primary Health Properties also attractive, and Tritax. And I think for me, those three would probably pip it, but I think you could do a lot worse, certainly.
I think the only other one I'd throw in there, which we've only covered the once, but that AEW UK one, do you remember where it was like they'd look at like special situations and it was quite a bit smaller, but they were very, very good at sort of almost turning around these properties and flipping them. But that's the caveat, we've only covered it once. But should we move on to the pharmaceutical company we should have bought?
Yes, absolutely. So Eli Lilly, which is, I think I'm right in saying, the biggest pharmaceutical company in the world now by market cap. It's owner of Mounjaro and Zepbound, which are essentially your Wegovy competitors. It's known as Mounjaro in the UK. In America, it's Zepbound. They had their Q2 results out with second quarter revenue up 48% to $23 billion against $20.7 billion expected, driven by Mounjaro and Zepbound sales increasing 91% and 46% respectively. A 60% increase in the volume more than offset a 13% fall in prices. Adjusted operating profit increased 40% to $9.8 billion, driven by strong top-line growth, and full-year revenue guidance has been upgraded to between $85 and $87 billion, compared with $85.4 expected, and performance margin guidance has also been upgraded. So far in 2026, Eli Lilly has allocated $7.1 billion to dividends and share buybacks, and the shares were up nearly 4.5% in early trading. In terms of valuation, the group have a market cap of $1.1 trillion, and that's $1 trillion, and they trade at 27.5 times forward earnings compared with the 10-year average of 28.6, and they have a yield of about 0.7%. I mean, I thought these results were very good. Interestingly, we're seeing it somewhat grow into the valuation the last few times that we've covered it. Interesting that there was a 13% fall in prices, and their Foundeo pill, which is the equivalent to the Wegovy pill, hasn't actually started as well as hoped, and its momentum is actually behind Wegovy, the oral Wegovy, which is interesting. I think in terms of the pricing pressure, because there's more competition, and particularly that Novo are happy as they can be to sort of compete, at least in terms of price, they're not able to get them quite as expensively as they were trading them at before or selling them at before. And I think that's also, you're seeing that since you've had Wegovy licensed at those higher doses, which gives similar weight loss to Mounjaro. And I think previously what you were seeing was that Mounjaro was hands down more effective, whereas now that still is the case, but you're able to have a higher dose of Wegovy. And you don't quite get to those Mounjaro levels, but you're getting fairly close. I think there were figures about, 23.7% weight loss with Mounjaro. And then with the triple dose Wegovy, you're getting sort of more like your sort of 20 point something. So you're getting better there. And there's a similar thing that's happening with CagriSema, which is Novo's next generation product, again, going for those sort of higher doses. So I think that's interesting. But gosh, what a company. And it does have that market largely sort of tied down, although there is, I would argue, space for other companies in there, albeit even if they're having smaller market shares and they can compete a bit more, certainly in terms of price. Interestingly, if you break down the Eli Lilly portfolio, you've got diabetes, obesity, cardiometabolic accounting for at least 65% of revenue, oncology, so cancer, about 10%, immunology around 8-10%, low single digits for neurology, and then other products, various legacy products, about 5-10%. So it's interesting. It has a little bit more diversity, not loads, compared with Novo, which is just pure play diabetes and obviously now sort of weight loss. I would struggle probably to pay up for this, and particularly given its current size. But in terms of the quality there, it's a fantastic pharmaceutical. Sam, what are your thoughts?
Very similar. I mean, when you're growing revenue 48%, obviously you are going to grow into any valuation quite quickly, but trailing PE 44.5, forward PE 27.5. So it's expensive, but they put up another couple of years like this, and actually 27.5 times forward earnings doesn't look that expensive. They only need to do it probably once to justify it, because you'd expect a company of this quality really to be around probably 20 times earnings anyway. So yeah, I think you could make a pretty strong argument for it. But I think it also puts into context just how poorly Novo Nordisk have done, given that they effectively created the industry.
Yeah.
Because their underlying sales growth was 7% compared to Eli Lilly's 48%. And Eli Lilly's 48% were saying the new products haven't taken off as well as we hoped.
Yeah.
So that 48 is quite a disappointing number, whereas with Novo, 7% actually seems quite good compared to what they've been putting up previous. So I think it does tell you the difference. But yeah, fantastic company.
Interested?
Yeah, probably not. I don't. I think, again, I don't love the idea of buying these companies with the idea that in a year or two you'll justify the price you've paid. I just think there's probably enough companies out there where you can justify it immediately, and then the growth is kind of a bonus rather than being dependent on that growth. But then equally, it's that attitude is why we've missed out on companies like ASML. So
yeah, that's right. Okay, well, of the companies this week, what's your top pick and what would come last?
I think top pick, I'd probably go Coca-Cola HBC, but it is difficult this week. And in reality, I don't think I'd quite want to pay up for it, but I think it's probably the best performer at the most reasonable valuation. Last is difficult because I think there's actually kind of 6 solid companies, but I think it would probably have to be Novo Nordisk last. I think it's just a bit of a mess, and it might be that it's in the process of being turned around, but I've got no interest in any more turnarounds. I think Diageo is the only one I'm quite happy holding. What about you?
Oh, it's tricky. I'd probably go with Diageo and have faith in the turnarounds that is happening there. In terms of last, that is difficult because I know Novo have been disappointing the last couple of years, but it feels harsh giving them a last. Probably Tritax by default, but that in itself is very harsh, I think.
I don't think there's any bad companies this week. There's not like a standout where it chooses itself. I think, you could make an argument for having any of the 6 in your portfolio.
Yeah, no, I would agree with you there. Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.